Nigeria's markets are on fire. The NGX just crossed 201,000 points. Returns are nearing 30% this year. And some stocks are already printing over 300%. So the big question is this the start of a historic wealth creation cycle, similar to what we saw in the 1970s oil boom? Are we getting close to an inflection point? Are we getting close to a turning point? Sit back with me and let's break this down. Now, what is really driving this rally and where could the next opportunities be? This week alone, Nigerian markets deliver a powerful signal. We saw a massive rally in equities, continued pressure on the naira, and still strong demand in the fixed income space. Now, when you step back, this raises a critical question. Are we getting close to a turning point, or are we at the beginning of a new market cycle in Nigeria? Because what we're seeing right now is not normal market behavior. You have equities surging, yields still elevated, and currency pressure still lingering. And typically, those forces don't all move like this at the same time. So the real takeaway here is this. The markets, Nigerian market is in a transition phase, and how investors interpret this phase will determine whether they capture the upside or get caught on the wrong end of the cycle. Now, here we are, Q1 2026. The NGX is already on fire, as I mentioned to you. The all-share index crossed the 201,000 points and returns approaching 30% year to date. One of the strongest performances globally. Market capitalization is also pushing towards the 129 trillion mark. And despite all the noise, the headlines, currency concerns, global risk, the market keeps climbing. So what's really driving this rally? So at its core, and to my mind, this is a liquidity and repricing story. Investors are moving capital, into equities as a hedge against inflation, whilst also reacting to improved sentiments around reforms and macro stability. But more importantly, we are seeing a re-rating of Nigerian assets. And that's something investors should pay very close attention to. Now, this rally didn't just happen in isolation. So we've had several key drivers. Obviously, if you've been following the space, we've been highlighting those drivers. Fiscal reforms, okay? We have banking recapitalization that is nearing completion. And we also have foreign inflows slowly returning and some degree of naira stabilization. Whilst inflation is still high, but it's beginning to show signs of easing in expectations. And that alone can change the dynamics. All right. That alone is enough to change how investors price risk. So the big question is, has the markets started to decouple from currency volatility, and is this sustainable? Because historically, Nigeria's equity market has been tightly linked to FS movements, crude oil price movement. But what we may be seeing now is a shift, okay, where domestic liquidity and structural reforms are temporarily overpowering currency risk. So the key risk, however, is this. If FX pressure returns aggressively, now it could reverse the sentiment. So let's bring this down to what investors care about most, all right, where the monies have been made. So over the past year, we've seen strong performances from blue chip companies like Dangote Cement, MTN Nigeria, Aradel, Bua Cement, and major banks, GT, Zenith, Post especially post the recapitalization exercise. So these stocks have not just performed, but they've created significant wealth for investors. And what's important here is that these gains weren't random. They were driven by pricing power, okay? Driven by scale, strong positioning within the key sectors like infrastructure, telecom, and banking. So the lesson here is simple. The market has been rewarding fundamentals, all right? Not just speculation. But beyond the blue chips, the real firework, I tell you, the real fireworks in 2026 have been in the small and mid cap space. So sit down and let me break this down for you. We've seen major names like Square Nigeria print over 300% return this year. RT Briscoe prints over 250% return. Deep Capital Management prints over 260%. Fortis Insurance surging past over 350% this year. Now, moves like this always raise the same question. Is this real opportunity? Or is this speculative excess? Because historically, when you start seeing triple digit returns in short period, it often signals that momentum, okay, is driving the market more than fundamentals. So for investors, the key takeaway is this. Yes, there are opportunities, but this is also where the risk increases significantly. Now, the conversation would naturally be, where could the next opportunity be, right? So if you're looking at where the next opportunity could be for the rest of 2026, right? There are several sectors that come to mind, and these are my picks. Oil and gas, especially with the rising oil prices and production growth. Stocks like Aradel will be major, will be stocks to look out for the rest of 2026. And cement and infrastructure, Dangote Cement and Boa Cement, they are expecting to benefit from ongoing development. In the telecom sector, I'll be looking at MTN and Airtel, all right? Particularly the data and fintech growth. In the banking sector, I'll be looking at GT, I'll be looking at Zen, especially those tier one banks names strengthening after the recapitalization. And why am I selecting this name? Because the next phase of the market may not be driven by explosive small cap moves. It may be driven by more sustainable, fundamentally strong companies delivering steady upside. So this becomes a rotation story, not just a momentum story. So what does this all mean for you? How should you approach the market? What strategy should you use to approach the market going forward? Now, there are about three different approaches that I like to discuss with you. One is chasing momentum. That's going after stock that have already run, rotating into quality names like focusing on strong fundamentals. Another strategy is positioning ahead of catalysts like major IPOs, the Dangote refinery that is going to come upstream June, July, or some policy changes. For most investors, and I would recommend for a smarter strategy, I would recommend a combination of strategy. Now, focusing on quality names with upside potential and avoiding overexposure to highly volatile small cap stock, and being patient with the entry points. Because at this stage of the market, discipline matters more than excitement. Right? And finally, we have to talk about the risk inherent at these times. With everything going on globally, oil spikes, geopolitical tension, rising yields, some investors are beginning to ask, Could this resemble the early warning signs of a broader financial disruption, similar to what we saw in 2008? Now, today's system, and this is my response, today's system is fundamentally different for what existed in 2008. But the key lessons from history is this: markets don't crash because of one event. Markets crash when multiple pressures build at the same time. And right now, we are seeing several of those pressures. Currency risk, spike in crude oil prices, global uncertainty, shifting capital flow. So the key lesson or the key for investors here is not fear, it's awareness. Okay. So as we wrap up, the key question or the big question here is it too late to get into this market? Or are we just getting started? Is the market just getting started? Because if this is the beginning of a longer cycle, the opportunities ahead could be massive. It could be significant. All right. But if this is closer to a peak, then positioning and discipline will matter more than ever. And that's exactly what we'll be discussing. That's exactly what we'll continue to explore and break down here on The Edge in the coming episode. If you like this video, please give it a thumbs up and subscribe to the channel. Until I come your way again next time, take care.